Imagine staring at a stock chart for 3 weeks straight, and literally nothing is drawn on the screen. Like not a single bar.
Right, just empty space.
Yeah, not a single line. I mean, in modern investing, that sounds like a broken app or, a glitch in your broker software.
Oh, totally. It
Yeah,
sounds terrifying to most people today.
right. But 100 years ago, Wall Street insiders realized that an empty screen is actually the ultimate secret weapon to blocking out the noise.
And that's so crucial because we are constantly conditioned to believe that more data equals better decision-making.
Oh, yeah, always.
You open any modern trading platform today, and it is just a complete barrage of sensory overload. I mean, you have red and green candlesticks flashing constant every second. Yeah.
Exactly. Volume bars moving, complex moving averages, crisscrossing like spaghetti, all while a financial news ticker screams at the bottom of the screen about, interest rates or what some CEO just said in an interview.
It feels like you need a PhD in advanced mathematics just to understand if a company's actually doing well.
It really does. But for the next 15 minutes or so, our mission on this deep dive is to completely cut through that exhausting sensory overload. We are throwing out the spaghetti charts and the 24/7 panic, and we are diving into an analytical breakdown of a legendary masterclass book. It's Tom Dorsey's point and figure charting.
A classic.
Yeah, we're looking at a radically simple method that, honestly, it strips away everything you think you know about financial charts.
Which stems directly from the original roots of this method. I mean, before Tom Dorsey modernized it and wrote the definitive guide, this technique actually dates back to the late 1800s.
Wow, really?
Yeah, pioneers of the market like Charles Dowd, they used what they called the book method.
The book method. Okay.
Right, because traders literally wrote prices down in physical ledgers. Like, they didn't have computer screens to generate infinite lagging indicators.
So they just had paper and pencil.
Exactly. They had to distill the market down to its absolute purest element, which is pure supply and demand. And Dorsey argues that is the only unbreakable law of the market.
Okay, let's unpack this. Because if we are throwing out the modern charts and the endless news cycle, we are left with a very, very stark reality.
Yeah.
Dorsey's core thesis is that everything else, the earnings reports, macroeconomic forecasts, geopolitical headlines, it's all just a massive distraction.
His philosophy is wonderfully grounding, honestly. Dorsey argues that whatever the news is, it does not actually matter in the moment you read it.
Because it's already priced in.
Because it is instantly digested, exactly, and reflected in the buying and selling decisions of the market. By the time a headline reaches you on your phone, institutional money has already reacted.
Right. The billions of dollars have already moved.
Yes. So the only thing that truly matters is whether there are more people trying to buy a stock or more people trying to dump it.
Okay. So if we are stripping the market down to pure supply and demand, the first casualty in this system is the calendar. Which, I have to say, this goes against every instinct I have.
It's a big mental leap for sure.
Because on a traditional chart, price is on the vertical axis, and time is on the horizontal axis.
Right.
If a stock does absolutely nothing for a month, if it just trades completely sideways, your screen still fills up with 4 weeks worth of flat, empty bars. It takes up horizontal space.
And that horizontal space creates the illusion of activity. It makes you feel like something is happening just because time is passing.
Yeah.
But point and figure entirely deletes that time axis.
It just gets rid of it.
Completely. A stock only takes up space on the chart when the price actually moves. It becomes this very clean grid.
Okay.
And on this grid, there are only two symbols. You have an X, which represents a rising price, meaning buyers are in control, and an O, which represents a falling price, meaning sellers have taken over.
I have to push back on this, though. Because if a stock sits completely flat for 3 weeks, doesn't the time it sits flat mean something?
It feels like it should.
Right. Aren't we losing valuable data by just ignoring nearly a month of market history?
This raises an important question, and it is the exact hurdle most modern investors struggle to get over when they first look at this methodology.
It's tough to wrap your head around.
It is, but Dorsey argues that time is just a catalyst for human emotion. Think about the psychology of staring at a flat line on a screen all day.
It's agonizing.
Right. If a stock isn't moving, it means neither the buyers nor the sellers have dominance. It is a total stalemate.
So you're just sitting there watching a stalemate, getting bored out of your mind.
Exactly. You get restless. You start overanalyzing minor meaningless fluctuations because you just feel this primal urge to act.
You want to do something.
Yes. The passage of time without price movement doesn't give you a strategic edge. It just makes you more likely to execute a foolish trade just to feel like you are actively managing your money.
Oh, that makes so much sense.
So deleting time forces you to focus strictly on when the balance of power actually shifts. The chart only updates when conviction returns to the market.
Okay, now that we understand the grid is purely based on price movement, we have to figure out the mechanics of, putting an X or an O on the board.
Right, the rules of the game.
Because we can't just draw an X every time the price goes up a single penny, or we'd be right back to that sensory overload.
Exactly, you'd have a million X's. You have to establish two structural rules before you even look at a chart. That's the box size and the reversal criterion.
Yeah.
The box size is simply how much the stock has to move to earn a mark.
So say we set the box size to $1.
Sure.
If our stock is at $50 and it moves up to $50.50, we do nothing.
Nothing at all.
The chart stays completely blank. It has to move a full dollar up to 51 to earn a new X on the grid.
Yes.
So moves of 50 cents or even 99 cents, they are entirely ignored.
And that rule alone filters out a tremendous amount of daily noise. Just think about how many stocks wiggle around by 50 cents a day and mean nothing. But the real structural integrity of the system, the real secret sauce, comes from the second rule, which is the reversal criterion. Traditionally, point and figure uses a three-box filter.
Okay, I love the analogy for this. Picture a giant game of tug of war in the mud.
A very messy game.
Right? The buyers are pulling the rope one way, earning X after X. They're winning. But the sellers want to take control and start pulling the other way to earn an O.
Mm-hmm.
But minor slips in the mud don't count. To officially shift the momentum and start drawing a brand new column of O's right next to your X's, the sellers have to drag the rope a full 3 feet, or in our case, 3 full boxes, in the opposite direction.
That's a perfect way to visualize it. So if our box size is $1, the stock has to drop by a full $3 from its absolute peak before you are even allowed to start a new column of O's.
Wow.
This three-box reversal is the absolute core of the methodology. It acts as a super aggressive, ruthless noise filter.
It essentially deletes intraday volatility. Like, let's say you own a really volatile tech stock. It's having a great run, printing a tall column of X's.
You're feeling good.
Yeah, you're up. Then, on a random Tuesday, a prominent analyst downgrades the stock, or there is a scary geopolitical headline, and the price suddenly drops $2 in an hour.
Which happens all the time.
All the time. On a normal candlestick chart, that looks like a terrifying red plunge. Human instinct just screams at you to panic sell.
Right. You see red and you want out. But on your point and figure chart, because that drop didn't meet the $3 reversal threshold, nothing happens.
Nothing at all.
The chart literally doesn't even record the dip. It forces you to realize that a $2 drop in a broader uptrend is just background noise.
The mud slips.
Exactly. The buyers haven't actually surrendered control of the rope yet. You only switch your attention when there is a legitimate, meaningful shift in the balance of power.
Because that three-box filter eliminates all those minor wiggles and fake-outs, the actual boundaries of this tug-of-war become incredibly stark. And that brings it to the battlefield itself, which is support and resistance.
The most important concepts in trading.
Totally. But on a regular chart, finding support and resistance is notoriously subjective. I mean, people draw these wild diagonal lines connecting random wicks of candlesticks.
Oh, I've seen some crazy charts.
Right. It feels like you could just draw a line to justify whatever narrative you already want to believe about the stock.
It often devolves into a self-fulfilling prophecy. And it's heavily influenced by human error and confirmation bias.
Yeah.
You want the stock to go up, so your brain actively finds a way to draw a diagonal line that points up, and you just ignore all the data that contradicts it.
But with point and figure, because everything is locked into this strict mathematical grid of boxes, support and resistance become glaringly obvious geometric lines.
Unmistakable.
Support is literally a horizontal floor of O marks. It's just a row on the grid where the price repeatedly stopped falling and reversed.
Right.
And resistance is the exact opposite. It's a flat ceiling of X marks where rallies continually die.
A literal ceiling.
Here's where it gets really interesting. Because of this rigid geometry, the buy and sell signals are ridiculously simple.
They really are.
There are no complex mathematical formulas or obscure indicators to memorize. The primary buy signal is called the double top breakout. And it is an instantly recognizable visual pattern. You just look for a column of X's that rises up and literally jumps one box over the wall of the previous X column. That's it.
What's fascinating here is the underlying psychology embedded in that simple visual of an X jumping over a wall. We have to look at what a double top breakout actually represents in the real world.
Okay, what does it represent?
It means the buyers in the market are now willing to pay a higher price than they were during the last rally.
Right.
Whatever supply of shares was sitting at that old resistance ceiling, all those sellers just waiting to unload their bags at a certain price.
The bank holders.
Yeah, they have been completely bought up and cleared out. The overhead supply is just gone.
So the path of least resistance is now upward into empty space. And the primary sell signal is just the mirror image of that, the double bottom breakdown.
Right.
An O column drops down and breaks one box below the bottom of the previous O column.
Yep.
The sellers are aggressively pushing to new lows, and they're overwhelming whatever buyers were defending that floor. It is just clean and definitive.
It removes all the second guessing. You are trading strictly in alignment with the prevailing momentum, dictated purely by who is winning the battle of supply and demand at that exact moment.
Okay, so I am in. The X jumped the wall, the supply is cleared out, and I bought the stock.
Nice.
But now I'm staring at a profit, and my human instinct is to panic sell before I lose it. I need to know when to sell, or at least how high this thing could theoretically go. Does Dorsey have a geometric cure for that anxiety?
He does, actually, and it is one of the most unique features of this entire system. It's called the horizontal count method.
Okay.
It calculates future price targets with a level of accuracy that often startles traditional analysts.
I mean, the source material breaks down the math, and honestly, if you just look at the formula, it can feel a little dry.
It's a bit dense on paper.
Right. You count the total number of columns across space, you multiply by the box size, multiply by the 3-box reversal, and then add it to the low.
That's the formula.
But the math isn't just a random equation. We really have to think about the why behind it. Let's picture a stock that has been bouncing sideways between support and resistance for months.
Okay.
On our chart, that creates a wide horizontal base of alternating X and O columns, just back and forth.
And that wide base represents a massive accumulation phase. Every time the stock bounces between those support and resistance lines, impatient sellers are slowly, steadily transferring their shares to patient institutional buyers.
I like to think of this wide base like a coiled spring.
Oh, that's good.
The wider the base on the chart, meaning the longer the stock has been accumulating and storing up energy, the more explosive the vertical move is going to be when it finally breaks out of that range. So the math we just mentioned is literally calculating the potential kinetic energy stored in that spring.
The horizontal width directly dictates the vertical height. Every column of X's and O's in that base represents massive blocks of shares changing hands over time.
Right.
When the breakout finally happens, all that stored energy is released. Having a way to mathematically measure that energy and project it upward, well, it changes an investor's psychology entirely.
Because one of the biggest mistakes retail investors make is nervously selling their winning stocks way too early.
All the time.
They see a tiny red candle on a Tuesday, assume the sky is falling, and cash out for a tiny gain, missing the massive run that follows over the next 6 months.
And having this mathematical roadmap cures that fear. You aren't guessing anymore. You know that statistically, based on the pure energy of accumulation stored in that horizontal base, this trend has a specific price target.
It gives you permission to hold.
Yes, it gives you the patience to sit on your hands, hold on to your winners, and let the market do the heavy lifting until that objective is reached.
Okay, so far we've been deep in the weeds on individual stocks. But nobody just owns one stock, right? And the market is this massive interconnected ecosystem. How do we apply this geometric logic of X's and O's to an entire portfolio?
This is where Tom Dorsey elevates the whole system from simple charting to professional portfolio management. He introduces point-and-figure relative strength analysis.
Relative strength.
Right. Now, a lot of people confuse relative strength with momentum indicators, like the RSI at the bottom of a normal chart.
Right, which just tells you if a stock is overbought or oversold in the short term.
Exactly. That's momentum. But Dorsey is talking about true relative strength. This means dividing an individual stock's price by a benchmark index, like the S&P 500.
Great.
You take that ratio and you plot that resulting number on a point-and-figure grid using X's and O's.
Wow. Okay, so you're charting the ratio itself.
Yes. If the stock is outperforming the S&P 500, the ratio goes up and it prints a column of X's. If the stock is underperforming the index, the ratio falls and it prints a column of Us. The revelation here is that a stock's actual price could be going up, making you think you're making a brilliant investment, but its relative strength chart could simultaneously be printing a massive column of Voss.
Meaning it is a weak stock that is just being dragged upward
Yeah.
by a broadly rising market.
Right.
It is riding the tide, not swimming on its own.
Which leads to Dorsey's absolute golden rule. Never, ever buy a stock with a negative relative strength trend.
Never.
Never. Even if the regular chart looks okay, you only want the absolute strongest horses in the race.
So what does this all mean? Like, practically speaking, let's say I own a company. I love their products. I use them every day. I think the CEO is a total visionary.
Sure.
But, their sector chart is printing a massive column of Voss, and the stock's relative strength chart is completely breaking down.
Oh.
Does this system mean I have to ruthlessly sell this company that I absolutely love?
If we connect this to the bigger picture, yes.
Yeah.
Absolutely yes.
That's brutal.
It is. And that is a really harsh truth for a lot of investors to swallow. Brand loyalty is a massive blind spot in investing.
Oh, for sure.
We saw this during the 2008 crash or, during the dot-com bust. People rode beloved companies all the way down to the bottom because they trusted the brand.
They just couldn't let go.
They couldn't. And they completely ignored the fact that the smart money was aggressively exiting.
This system is designed to ruthlessly sever your emotional attachment.
Yeah.
Like, you do not care about the logo on the building. You only care about supply and demand.
Exactly. If the smart money is fleeing a sector, you will see it immediately because the sector's point and figure chart will flip to Oz.
And what do?
You sell without hesitation, and you rotate that capital into the sectors that are dominating the X columns. It is a systematic way to ensure your money is always parked with the elite market leaders.
It is mechanical. It is cold. And honestly, it sounds incredibly freeing.
It really is.
Which brings us perfectly to the mindset required to actually pull this off. Applying this masterclass, especially for someone who wants to escape the anxiety of modern finance, it requires a complete psychological shift.
Totally. The ultimate goal of point and figure charting isn't just to spot a good trade, it is to build a psychological shield.
You really have to embrace the boredom.
Yes.
I mean, this is not day trading. It is slow, deliberate, and methodical. If you were managing a portfolio this way, you might only make a handful of adjustments an entire year.
Think about the peace of mind that brings, though. When a stock you own drops 5% in a day on some random news rumor, traditional charts make you sweat.
Oh, yeah.
They highlight every frantic wiggle, and the time axis keeps marching forward, pressuring you to act. But on your P&F chart, that drop likely doesn't even trigger a 3-box reversal.
The chart just sits frozen.
Right. It does not draw a new column. It does not provoke you.
You just wait patiently for a wide base to build. You wait for the decisive X to jump the wall. You calculate your horizontal count, set your stop loss just below support, and then you just step away.
You let the unyielding laws of supply and demand play out.
By stripping away the time, the volume bars, and ignoring the talking heads on TV, you replace chaotic financial anxiety with the clean, elegant geometry of the market.
It is the timeless power of radical simplicity. I mean, the market hasn't fundamentally changed in 100 years because human nature hasn't changed.
Right.
Greed and fear still look exactly the same on a grid of X's and O's as they did when Charles Dow was writing them in a letter.
We set out to find a way to cut through the exhausting noise, and Tom Dorsey's point and figure method really does feel like the ultimate armor against the daily panic.
It truly is a masterclass in market survival. But, as we wrap up this deep dive, it leaves us with a fascinating, almost unsettling question about the future.
Oh.
Yeah. If this entire methodology works because human psychology, fear, greed, and impatience, hasn't changed in a century.
Yeah. What happens when AI and algorithmic trading, which lack human emotion entirely, completely take over the market?
Oh, wow.
Will the timeless geometry of X's and O's still work when machines, rather than humans, are the ones playing the tug of war?
Now, there is a thought to chew on the next time you feel the urge to check your portfolio. Maybe the best thing you can do for your wealth right now is simply to close the app, embrace the boredom, and trust the geometry. Keep your armor on, and we will catch you on the next deep dive.